Hi, thanks so much for joining in. We're talking about Your Money Matters on NDTV Profit, and my name is Mathew. Now, when it comes to equities, a long-standing advice that a lot of investment advisors will give you and have given you is that you need to stay the course. And I know that it sounds a little trite to say things like this, where you keep saying, keep your SIPs going, stay invested for the long term, but then often you have the opportunity to talk about data that reinforces this fact. Now, over the last couple of months, you will know that there is a high degree of geopolitical tension that has played out not just in certain parts of the world, but also in our own backyard. And you had Operation Sindoor pan out. And what I have focused on is that there was a low point for the broader markets in April, in the start of April. And since that point, there's been a very sharp and very stark rebound. So since the low point in April to where we stand right now, the mid-cap index has gained 19.5%. And the small-cap index has gained over that. So the point is that if you had stayed invested, you would have made money if you had invested in the broader market funds. And a lot of you will have those SIPs running. But if you haven't, if you pulled out, what should your strategy be? And if you're investing for the first time, what should you bear in mind? Joining me is Mohit, who is a co-founder and chief executive officer of Moneyfront, as well as Vinit Iyer, who is managing director and principal officer at Prodino Wealth. Thank you so much to the both of you for taking the time. First, the question to you, Mohit, before we get into individual schemes, is I want to understand from you what your clients spoke to you about. And of course, I'm pretty sure that you managed to convince them to stay invested. Those people that didn't and those people that pulled out, they wouldn't have had the best experience. Is this a good example, or do you think that it's too short a time frame?
Hi, morning, Alex. Always a pleasure to be speaking with you. Look, I think this is one of the classic textbook cases, and I think it should be made a case study the way last 6 months have panned out in the market. There was every bit of negative news which one could have imagined, every bit of wrong signals in the market where one would be tempted to sell, book profits, and cash out, sit on cash, liquidate, and not just investors. I think the best of fund managers, Alex, have taken that call where they've sat on cash, right? Yet, in spite of the geopolitical tensions, in spite of the macros, whatever they have been done, in spite of the US tantrums and multiple myriad things which have happened across us, the markets haven't moved an inch. If you would slept, let's say at the start of the year, and you would be waking up now after whatever 6.5 months, you will realize that the world is where it was in terms of markets. It hasn't moved an inch, right? And even from April 7 lows, which we saw, the markets have rebounded astonishingly well. So anyone who was wanting to take a cash call, was wanting to sit idle, stay out of the markets, have got a bitter lesson, because you don't get those entry points in the market, Alex. You definitely get exit points at bad news and bad geopolitical events. But the rebound is so sharp. It's always a fast V-shaped recovery which we have seen in the market, and so sharp that most of us actually can't enter back in the markets. And that's a very, very classic telling example of why investors should just stay put and avoid all the noise and clutter around the levels. And just to answer the last part, yes, our clients have all stayed put this course, and we have made sure that none of them, at least because of geopolitical reasons or the uncertainty in the market, are liquidating. If they were to liquidate, then it will always be basis their goals and asset allocation.
Vinit, coming to you, just because it has occurred in the past and just because we see similar scenarios play out repeatedly doesn't mean that the next crash will be the same or the next experience will be the same. I think this is a hard lesson for a lot of people to learn. But having said that, people still tend to keep cash, saying, I want to deploy at these levels, and they miss out, as we've pointed out. What do you advise your clients to do? Are you advising them to remain fully invested at any given point of time?
Yeah, thanks, Alex, for having me here. It's always good to be on your show. So we follow a premise of financial planning, where anything which is more than 5 years away as a goal, we recommend them to invest in the long-term equity strategy, which has, of course, allocation to big, small, as well as the other categories. And we also tactically ensure that the mid and the small cap category does not have more than 15 to 20% allocation individually. So we ensure that whenever the goals are getting near, we are moving out of equity and then ensuring that those money is available in safer assets. So in case of any kind of events which is going to impact the market negatively, those things does not impact the value. And the classic example we saw was in 2020, where all of a sudden COVID came in from nowhere and the market crashed massively. The second massive crash that we saw in the last 25 years after the global financial crisis. So even then, clients were not panicked who knew that the money that they need after 5 years, those are invested into equity. Anything which is short term is sitting safe in a hybrid fund or maybe a debt fund. So this time around also, in fact, there were a little bit of curiosity in terms of what are the things or what are the opportunities that are available so that if people have cash, they can deploy. That's an interesting shift that I'm seeing. Plus, what we are also looking at is if people have lump sum, we are deploying that in stages over the 6 to 12 months with through the SWP SIP route, and we are kind of averaging out the purchase with a time horizon of at least 3 to ideally 5 years.
I assume that you are using STP, the systematic transfer plan route and SIP route, correct? Because you said SWP, that's why I'm just wondering.
Yeah. So we work a little differently. Rather than having say 5 different schemes and then putting money from debt to equity through those 5 debt funds, we have one debt fund and then we set up a systematic withdrawal plan, and that systematic withdrawal plan comes into the bank account, and from there we fund the SIP. So it's not directly going from scheme to scheme. It's actually going from bank account to the equity scheme.
I assume that that is something that allows you to have more flexibility in the schemes that you invest in, because
Absolutely.
you don't necessarily have to transfer from the debt fund to the scheme from the same category. Okay, so let's talk about this. This is an interesting strategy. So let's pause our conversation on mid cap and small cap just so you understand exactly what is happening here. So a lot of people utilize systematic transfer plans to transfer from a fixed income scheme of one category, of one mutual fund, to equity of the same mutual fund. That's the restriction. You can't, for example, transfer from a fixed income mutual fund, say a liquid fund of a DSP, to a Nifty 50 index fund of an ICICI Prudential mutual fund. You can't do that. You have to choose a fund of DSP. So what Vinit is suggesting is that he has a debt fund of a particular fund house. He allows the money to come into your bank account through a systematic withdrawal plan, and the bank account is then used to push money into possibly 4 or 5 schemes through an SIP route, which is quite an interesting strategy to go by. Okay, so that's insight as to how you can stagger your investments going forward. But let's talk about first the top performers in the mid-cap category. And let's pull up the top 4 odd or top 5 odd. You have ICICI Prudential, you have HSBC mid-cap, you have Invesco India mid-cap, and you have Canro Robeco mid-cap fund, which are the top 4 performers in the mid-cap category. And the outperformance is anywhere between 3.4% for Canara Robeco to about 5.9, nearly 6% for ICICI Prudential Midcap. Let's talk about what has worked, because Mohit, you have more schemes in the midcap category that have managed to beat the benchmark than the small cap category. Why is that, and what has worked?
Alex, look, I think one of the stark things which we have seen from April 7 lows is that the mid-cap index has kind of bounced back by almost 19.5%, whereas there are only 4 or 5 schemes which have given considerable outperformance on the index, though there might be a total of around 8 to 10 odd schemes which have outperformed the index by a margin or a fractional point. Yet there are almost a good large majority of schemes, perhaps 16 odd schemes, which have underperformed the index. So it is a telling sign on active versus passive debate, which we can have for some other day. Having said which, the few schemes which you named, let's say an ICICI Prudential Midcap or an Invesco Midcap, an HSBC Midcap or an Canara Robeco Midcap, which are the first 4 names which have outperformed significantly. I think one of the bigger signs which I see emerging out here is they have a very, very manageable size in spite of being in the mid cap space, right? So all ranging between 6,000 odd crore to around 10,000 odd crore kind of an AUM gives them that flexibility, gives them that maneuverability, the ability of the fund manager to move a little quickly. Unlike the large schemes, if you see all the large schemes in the mid cap category, which are over 30,000, 50,000 crore kind of an AUM, they have significantly underperformed in this rebound, right? And perhaps they need a little bit more of pacing or portfolio designing before they can start performing like the benchmark. The second thing which I note is because of this rate cut significant movement which happened and which was 50 bips, which was unanticipated, the portfolios which were positioned to benefit more by virtue of the rate cycle reversing are the ones which have actually fiercely outperformed, right? So anyone who was positioned a little bit in non-PSU banking space, or let's say perhaps only an NBFC space in the financial services, or a little bit of rate sensitive sectors are the ones who have actually benefited the most in this rebound. So if you see few of these funds, they are a little heavy on such positioning, right? And one last point out here, there are few similarities if you see across some fund houses. So let's say if you were to pick up Invesco for a case in point, right? Across the categories, if you see, whether it be large cap, mid cap, small cap, they have handsomely beaten the index. Sometimes the portfolio positioning is such across fund houses, Alex, or the style of investing is such that when the cycle turns, they are across the board, all their schemes benefit. So I see this happening a lot on the Invesco, Bandhan, DSP, few of these AMCs, which are now playing perhaps a mix of quality plus growth cycle. And that specific positioning in their portfolios have helped them a lot across these fund houses, if you were to notice.
Interesting points that you make, and that last point is exactly what I wanted to get from you, which is at any given point of time, there is a seasonality in the kind of strategy that tends to work and that tends to not work. And there's no unmitigated 3-year, 5-year, 7-year time frame where only one strategy will work. So you will see moments in time when your portfolio is underperforming your neighbors, and that's perfectly normal. But Vinit, there are a few parameters that you would look at. In an upcycle, when the market is doing incredibly well, you would look for schemes that have an up capture ratio that is better than everybody else's, which is you look for schemes that are doing better. And obviously, the schemes in our list, which we've discussed right now and what Mohit has just spoken about, would have a better up capture ratio than everybody else. Would you focus more on the up capture ratio, or would you focus more on the down capture ratio though?
In fact, both are equally important. Of course, in a bull market, you would want the fund to give you better returns than the benchmark. And of course, when the markets are not doing well, you would want the fund to kind of have a lesser low than the markets. So both are equally important. I would not discount any one of them. Interestingly, if I look at, and just adding to what Mohit said, if I look at why investors kind of outperform, I see a very interesting trend over there. They have a 47% allocation to mid cap and a staggering 21% allocation to a small cap in their mid cap fund, and about 30% to large cap. So they're kind of equally distributed their funds in these three categories. And when you talk about small cap funds like Bandhan, they have been sitting on about 13% cash. And probably one of the reasons why their funds have performed well in the last 1 year is because of the cash call that they've taken. And maybe they've kind of maneuvered their portfolio in a way that when the market kind of rebounds, if they're kind of putting in that cash, they have that upside capture. And at the same time, the drawdowns are lesser for their funds.
Yeah, that's an important point that you make. Just as we're speaking about winners, we also have to speak about those strategies that have not worked and why they have not worked. And Mohit, as I look down the list, at the bottom of the list are schemes like Baroda BNP Paribas Midcap Fund, you have Quant Midcap Fund, and you have SBI Magnum Midcap Fund, all of which have underperformed to the extent of 5% to 7.9% versus the benchmark, which is quite a big gap. Of course, this is only a 2-month time frame. Why has this occurred though?
Alex, I think A, you are right that it's only a 2 month time frame. B, however, the reality is that versus an index of around 19 and a half, 20, these funds have significantly outperformed by a margin of around 5 to 7 odd percent, right? And I think market has completely changed in its style and texture. And if you were to notice few of these schemes, specifically the quant schemes across the board, across the spectrum, it's not just the mid cap, Alex, it's also the small cap and few other categories. If you were to watch, quant was a predominantly momentum oriented theme or a momentum driven fund house, right? Most of their schemes did exceptionally well when the market was on a tearing rush on an upward direction, right? And their schemes were outperforming with a large extent, and that's where droves of investors flew into the schemes. When the market's texture broke, when the reverse cycle happened, the momentum has completely got broken. The momentum theme has lost its sheen, and hardly there are any stocks which are now working on momentum. I think the cycle has reversed a little. If you see quality funds or the fund houses which are more oriented towards quality are picking up very specifically in this cycle, and also growth oriented companies, right? So a mix of quality plus growth is something which these funds were lacking. That's my clear reading out of it, and that's kind of led to a stark underperformance. And my sense is if the cycle keeps thus for at least 6 months to a year, then perhaps these funds will again take a longish while to rebound. Having said which, no fund is a bad fund, Alex. It's just that the right cycle has to strike at the right time for the fund to deliver returns. So for investors, it's just about patience and staying put with the themes.
We'll come back to that. We'll revisit that. But I do want to talk about small caps as well, because in the small cap category, Vinit, I'm coming to you first on this one. There are far fewer outperformers. There are just two schemes that have even 0.5% or more. You have DSP small cap fund that is managed in this time frame, and I know that it's a very short time frame, but it's still a time frame where the index itself has risen by over 20%. DSP has managed to achieve a 1.4% higher return, whereas HSBC small cap has managed a 0.5% increase. Invesco has more or less matched it. And then everything below that, GM small cap, for example, is performed not as well as the benchmark, 0.5% lower. UTI also 0.5% lower, going down the list. Why is that?
I think these funds have taken a good cash call. Plus, if you look at the small cap category, it's a wide choice that the fund manager has. And stock picking ability becomes a very, very important factor when it comes to the outperformance. So I think DSP and HSBC have done well on this part. Probably the stocks that they've picked have done well, have reasonably done well in the last 2 months, and because of which you are seeing an overperformance. And if I look at the broader index as well, the small cap 250 index, it's trading from a long-term median PE. If you look at the discounting, it's just 3.85% of discount that it is trading at. So, which means that there are pockets in the index in terms of securities where you have opportunities where it's this kind of undervalued, probably out of flavor, because of which if the fund manager takes a stance and if that flavor works out, if liquidity gets created in those stocks, of course there's an upside. So I feel that these two factors have helped these two funds to kind of outbeat the benchmark and of course outbeat the other peer group in their category.
Okay. Mohit, do you want to come in on why so many schemes in the category have underperformed? And of course, I buy the argument, the fact that small cap funds, because of the universe available, it's difficult to build a portfolio, and therefore beating the benchmark is something that star fund managers are able to do. Why is it that they've not been able to do it in such a broad-based rally?
Look, Alex, it's actually very surprising to me because small cap as a category has huge choice to offer compared to the other two categories, right? And out there, typically the whole premise, which we've been often debating, is that the fund managers should be able, along with their experience and significant reading of market, they should be able to beat the benchmark. Having said which, 2 month is perhaps a little low threshold for us to evaluate. However, not a large majority of fund managers underperforming is actually concerning, honestly. And by virtue of if your portfolio was a little index hugging, or if your portfolio was tilted towards those high PE stocks or very expensive stocks or stories which were predominantly available, let's say last year, and if you haven't been able to change the texture of your portfolio very quickly, right? Then I think those are the portfolios which have suffered significantly in this last 2 months of rebound. If you see the top performing portfolios, let's say if you were to evaluate DSP per se, Vinit Sambre obviously has been managing that fund as a CIO now. He overlooks everything along with Resham Jain. But the fund was extremely heavyweight on consumer discretionary as a sector, and then materials, which if you see all the other funds, they aren't so heavy, barring one or two funds which have actually done very well, perhaps a Bandhan or something else, have consumer discretionary as a significant overweight exposure in their portfolios. And I think that's where the reading has gone right. And they've been able to significantly outperform. Again, we have to understand small cap as a category does not offer too many choices in the financial space. So the fund managers are a little constrained as to what to pick up out there, unless they pick it up as part of their large cap allocation or something. So trying to play the small cap within what is available in that space, and they're finding rate sensitives and finding something which will play out once the cycle turns, along with a good growth prospects. I think that's what has led to these one or two funds giving us a positive return.
Okay. Vinit, comment about the number of holdings in these small cap funds. And I have asked this question specifically about Nippon India small cap fund in the past. I mean, they've managed an outperformance over long periods of time, but I'm seeing that number tick up as the weeks go by. It's now at 240. And you have a few others that have a significant number of shares, like Bandhan Small Cap, for example, that has 190. You have Axis Small Cap that has 135. But by far and away, Nippon India now has the most stocks in the small cap category. Of course, it is holding the largest assets under management by far. But is that something that you pay attention to?
See, it could. I mean, it's actually in a way better for a fund to have too many holdings. There could be some management challenges there, but from a liquidity standpoint, and if the fund size is getting larger, if you're not getting adequate opportunities with the existing securities, you want to kind of diversify further, and that actually creates a long tail. So whenever we were speaking to, in fact, this was one of the concerns in some of the quarterly researches that we did. And when we reached out to the team, we got to know as an understanding that it's a purposely driven thing just to maintain liquidity, because if there is any sudden drawdown, they have enough securities that they can kind of liquidate and create those liquidity for kind of maintaining the redemptions. And in fact, if you look at some of the other category funds like Parak Parikh, FlexiCap, even they have started having large number of holdings, being one of the largest in the FlexiCap category. So I think as and when the fund grows in size, there is popular demand, and the investment manager is not finding decent opportunities, the tail would go up. So there could be an inflection point where if it becomes too much to kind of manage, so we need to kind of wait and see. But at this point in time, I think look at the universe, 240 is still not a very, very huge number. I think we're good.
All right. So let's talk about what an investor should do if they are looking to invest for the first time. And we have a certain set of data. Of course, I'm stressing again, this is only 2 months. And so therefore, the outperformers in this 2 months should not necessarily automatically find it into your buying list. Mohit, I'll start with you. What advice would you give in the mid-cap and the small-cap category?
Alex, look, I've always been very clear. One has to have a mix of active versus passive in all the categories which one is investing in. And I would go with a mix of one active, one passive in both the categories, just to get a full flavor of what the index is doing. It could be a factor based index. If you are really keen on it, then I think that's a great strategy to have, or it could be a plain vanilla index, and one active fund which you really believe in, where you kind of resonate with the fund manager's objectives and the philosophy, and then you stick with it. Don't just try and change your small and mid cap allocations basis 6 months of performance, underperformance, or overperformance, because every fund will get its cycle, will get its day in the sun. And I think one has to patiently wait for that day. When it comes, they really come very, very hard with performances. So one has to just.
Yeah, to reinforce that, sometime next week, what we'll do is we'll pull up the worst performers of 2025, or maybe at some point in 2025, and we'll pull up the list of worst performers over the course of the last 1 year. And you will notice that there's a very stark difference between the two, even though it's a pretty short time frame. Vinit, last comments for you. Advice, similar question to what I asked Mohit.
Yeah, so I think in the mid and the small cap, actively managed funds has a very good chance of kind of outperforming over a longer period of time. And I was reviewing some data for the past 1 to 2 years, and I see that majority of the at least the top 10 category funds have outbeaten the index by quite a margin. Some funds have beaten in excess of 5%. So I would still stick with the actively managed funds in the mid and the small cap space. Probably in the large cap space, I might go with a active passive kind of this thing, because I feel that even today in mid cap and small cap, it's a stock picking ability that actually derives the performances. Probably 10 years down the line, those options may not be there, and that point in time, probably like a mixed strategy of active passive would work well.
Okay, fair enough. A very quick last question to both of you. I'm not asking for recommendations, but what's on your short list in both the mid cap and the small cap category? Vinit, first you.
So we are sticking with Kotak Emerging in the mid-cap category, and in the small cap, we're still sticking with Nippon being the largest fund. And since they have been having the experience of managing this since more than 20 years now, so we want to kind of stay with someone who has the ability to kind of stretch through the difficult times. So these are the topics in the category.
Mohit, what about you?
For me, in the mid-cap category, Alex, it's the quality factor. DSP mid-cap 150 quality 50 index fund. And in the active, I'd go with an Invesco mid-cap. In the small cap, we've been sticking around with Bandhan small cap for a while. And if someone is really keen, then we also go with a passive choice in the small cap.
Fantastic. Okay. All right. Gentlemen, thank you so much for joining me on this edition of Your Money Matters. It's been an absolute pleasure speaking with you. And viewers, that brings us to the end of this edition. As I pointed out, do let us know what you think in the comment section, and stay tuned. Lots more coming up on NDTV Profit.